let me go through the presentations, okay? Who's got presentations today? I only see one hand. Oh, three? Okay, so that's 15 minutes right there. So this will probably take like an hour.
Okay.
Okay? And then make sure you get me the paper and stuff in the PowerPoint presentations. If you only have one, you maybe need two, or I need three. And then we're working on a paper, right?
Wait.
So give us your strategy so that you can understand. Well, give me as many as you can. Start writing the paper. So why don't you tell us what you're doing? Because I think yours is probably the most advanced.
So for my, so last week, my presentation was just something thrown together real quick. But then, so moving forward, I decided, so this week, I'm doing a presentation on a REIT, or just REITs in general, like an outlook. And then the next following few weeks, I'm going to be doing presentations on different REITs, like industrial, residential, commercial. So that way, every week, I'll have something new, but it'll still be about REITs.
What's a REIT?
Real estate investment trust.
It's publicly traded. The shares, the companies and their stocks trade on the New York Stock Exchange. They're just like just like Facebook or whoever, but their assets are real estate, and they lease space. So they're publicly traded real estate companies.
So that way, by the end of like maybe 5 or 6 weeks, that would be one research paper right there, all on the topic. Versus like you're doing something this week and then something else next week, and you're gonna have a hard time at the end trying to put them together into a research paper.
Exactly. So you'll talk about REITs in general, maybe talk about the history of REITs, how they came into play, how they capitalized over time, how they changed over time. Then you're going to talk about the different sectors, right? The property sectors.
Today's more was just like an overview of how REITs did the last year and what to expect looking forward into this year.
Okay. Well, I'm just thinking one way of doing it may be an overview of REITs, how they've developed. You can talk about the performance of the REITs over time and currently. You can talk about the different property sectors, and then you can talk about the individual companies, and then maybe pick a company to do the valuation, which will be Essex at the end of the course, so it all rolls up into one nice paper.
So then maybe even next week, which I should have first, then I should do a presentation on that.
Yeah. Yeah.
Just throw that in front of me.
Yeah. Yeah. But just be careful. Don't pull everything from the one source. If you can pull some from multiple sources, then that'll give you more credibility, when you're doing the presentation. So that's a great paper right there. And then my recommendation was to do the research on the individual REIT, which we're going to do Essex Property Company, okay? So he's going to look up Essex Property Company. He's going to get the annual report. He's going to get the most recent quarterly report, and he's going to get the supplemental report. In the supplemental report, it basically lays out where all the properties are within the portfolio. So it's going to tell you X percentage of the portfolio is concentrated in Northern California and Southern California, maybe on the East Coast. And then what he's going to do is he's going to go up to Cushman Wakefield, CD, maybe Marcus and Millichap, and get the market research reports based on the markets in which the company has the majority of the portfolio, and do an underlying market research analysis of the underlying fundamentals of where the majority of the portfolio is concentrated. So you're doing a real estate analysis that then rolls up into the projected FFOs for the valuation for the recommendation within the presentation, just like we did last semester. So what you're doing is a more comprehensive research report that we probably should have done last semester when we didn't have time to do it. So you're doing basically a top-down and a bottom-up approach to eventually do the valuation for the individual company. That's a great research paper. Okay. Anybody else have any research strategy? Because remember I asked you to bring me a research strategy. I know you have yours. You have yours. Do you guys have a comprehensive strategy? You're still struggling to figure it out. Do you have your research strategy in place?
Sorry, I missed out.
That's okay. Well, we already were talking about research strategies.
What you're going to be writing about?
Oh, what I'm writing about? Today I'm writing about
about,
No, I want the research strategy.
so how I found it?
No, I want the research strategy.
Explain.
I want to know what you're doing. I mean, a lot of you are doing is just one-off research papers. You don't have a research strategy. You're not studying housing economics and housing policy, and then housing policy impacts on a geographic area that then drills into a neighborhood, that then drills into a certain type of product type.
Okay.
And then you're making a recommendation to the board of directors on how to use the policy and the economics and the individual, market research for that given location for recommendations for investment in that area. So you can do research all you want for just research purposes, but at the end of the day, as a business person, it's worthless, okay? Unless the research is a business strategy that we can basically commercialize and monetize to make money off of it, that's great, that's what we do, but we don't do research just for research purposes. That's what academics do, okay? And I'm not an academic, okay? I'm a business person. So the question is, what research strategy have you laid out that basically is going to be a business model that we're going to use to invest in? And we're going to invest in REITs.
Okay. Well, so my presentation from last week kind of works with my presentation this week. Last week I did interior and exterior design, but then that got me thinking about why is it so expensive? So this week I'll be talking about housing affordability. So I was pretty narrow about interior exterior. This week I'm going a little bit more broader about why do we pay so much? Why is it hard to find affordable housing in the U.S.?
And then how do we as a business make money off that research?
Well, once you understand the concept of it, maybe you'll be able to change your strategies and think of how you want to.
Okay, we all need to be thinking about how we're going to make money for the company. Okay? We are the research department for the company. We are basically been tasked to basically create a research agenda that will basically help lay out the strategic, tactical, and operating plan of the company for the next 3 to 5 years. If we're just doing research for research purposes, we're going to get fired. Okay? And if we can do research to create strategy and tactics and then create operational plans to be able to execute on those plans so that we can make money along with our shareholders, we're going to keep our jobs. I've been fired multiple times for doing research for research purposes. Okay? And when you can turn the research into strategy and show the value of it and how to make money for us and the shareholders, we're going to keep our jobs. If we do research for research purposes, we're going to get fired. Okay, so when you lay out your research strategy, it has to be tangible. Okay, how are we going to turn this into a business strategy and a business model, and how are we going to execute on it, and how are we going to profit from it? Okay.
I guess my research strategy at the moment is just learning and understanding.
I know, but you need to be focused.
Yeah, I need to focus, but I just wanted to know more about it before I got a focus topic.
That's fine. Well, investing in homes for value add plays for turns, or to be able to invest in these homes. One is, what's the underwriting criteria to select the property? That's the first thing. Okay. Once you pick that, then you start selecting properties. Once you select the properties and you buy the properties, you're going to have to put together a capital budget and start plowing money into these properties to reposition them, to resell them. The question is, what can we do? What's the criteria to buy the properties? Okay, and so we can get a good value on that. Then what are the top 4 things that we need to do to the property that will increase the value so we can get a return on cost? There's a ton of research out there that basically tells you what the 4 things are when you go into a property, the 4 things that you need to invest in, and that will increase the value the most. Then you do that, and then the question is, what can we sell it for? How much profit are we going to make? If you can actually go out there and find 5 properties that we should buy based on the underwriting criteria, then you put together a strategy, a capital budget strategy, to basically remediate the physical deterioration and functional obsolescence of the property, reposition it, and give me a timeline, and then bring that thing back on the market, what you think you can sell it at, and what the profit's going to be. Now that's extremely important. You can sell that plan. You can do the plan yourself, and you can sell that plan. Okay? So I'm going to push you into application. Theory's fun, but at some point it's worthless. Okay? If we can make money off of it for our clients and ourselves, then we're in. Okay? Did you have a strategy?
Right now, I'm just doing my fixing and flipping houses.
Okay, well, maybe all three of you should work together. Since you got the construction person there, you got the finance person
So
there.
I was gonna ask, like, I'm reading a book, and so as I read every chapter, I'm gonna know more about
Yeah,
fix
yeah.
and flipping. Is that okay to like?
Yeah, you're just gonna need to put together a business plan
Okay.
to operationalize that. And then books are usually 2 to 3 years, maybe 5 years out of date, so you're gonna need to update the book and the procedures, because there may be new techniques that have been brought in since the book was published.
Definitely.
And then bring in some relevant current information, do some what-if analysis to see if you can actually implement that as a business plan.
Sounds
So strategy, investments, and construction management. So you basically have a flip team right in front of you. Now you just need to coordinate it, put it into a business plan, do some research to see if it's a viable program, and then test it on maybe 3 or 5 properties to see if you can actually get it to work. Now that will be extremely valuable for you. Okay, and there's a lot of research in that area. Go ahead.
Maybe I can pick your brain on developing my research strategy,
Mhm.
because I want to focus mine around Bay Area real estate market, but not just the real estate market itself, but financing.
Okay, from a mortgage finance standpoint,
Yeah, so I wanted to,
one way to do it would be to look at you want to focus on commercial or residential.
residential.
Okay, so I would see if you can find some data on geographic areas within the Bay Area where there is the highest equity in the area. Where's the majority of the homes that are almost fully paid off or fully paid off? Right? I mean, isn't that the key? So you go, there's a lot of homes in North Beach, in San Francisco. There's probably pockets in Piedmont and Montclair where they've had significant home price appreciation over the last 10 to 20 years. The people who bought their homes in the 80s and the 90s, their houses have basically quadrupled. They went from $250,000 to $1 million. So now they're probably all pretty much paid off. So why wouldn't they get a 50% loan to value, pull some money out of the house, maybe pull out $500,000 and service a $2,000 mortgage payment per month? Would you do that? If you have your house basically paid off, you bought it for $250,000 in the 1980s. In the 1990s, the thing's totally paid off. It's worth $1 million. I slapped a $500,000 mortgage on it. I pay $2,000 a month to service the mortgage. Would I do that? Absolutely. And you're pulling the money out tax-free, okay? Because you're pulling it out. Now that's the way I would do it. And I would sell that program to the homeowners. So you're the mortgage broker. You're basically, you're either going to do mailers or something, say, hey, do you have, locked up equity within your house? Would you be interested in borrowing on the equity of your house? Do you know that if you've completely paid off your house and your house is worth $1 million, a $500,000 tax-free mortgage would cost you only $2,000 a month? Would you be interested in talking to me about a mortgage program? Would you be interested in that? Yeah. Because then you can take the $500,000 and go buy another house someplace else. And start leveraging the equity that you already built in your one house.
It's already paying for it, right?
Yeah, that's what I would do.
No question. Can you help me develop,
Yeah, yours is doing the fire stuff?
yeah, so
Okay.
fires in Northern California, just not, actually all California could be.
Yeah, I would probably, just for some advice, I would probably, because we're working on a program up in Napa, okay? So the first thing is you got to do the assessment of what the damage was from the fires up in Napa, okay? How many homes were destroyed, all right? What was the equity in those homes? What is the fire, the insurance payout for those homes? How many homes are actually going to be reconstructed and how many aren't going to be reconstructed? There's a lot of homes right now that aren't going to be rebuilt, and the people who owned them basically got the insurance money, put their lots up for sale for $250,000 and are gone. They've moved to Phoenix. Because in that market area, I think the Tubbs area, maybe there's some other areas in Napa, there's submarkets up there, where the homes that were there before were worth at least $1 million. Okay, so I bought the lot for $250,000. I basically rebuilt the home for $500,000, so I'm into it for $750,000. I sell it for $1 million, I pocket $250,000 bucks. There's your program right there. It's already being done. So you could do the research at the fire level. You could look at the total homes that were destroyed. You could look at the homes that are going to be rebuilt. You're going to look at the lots that are currently for sale, how much of the lots that are being for sale, what's the construction cost to replace the house, and what's the profit for the developer. So we're doing that right now. And the city up there is, and the county is willing to allow you to get permits on the new house. If you use the existing drawings, the existing permitted drawings from the original house, they will expedite the permitting process in a week.
Wow.
Okay? So they will permit, if you bring the plans, the original plans with the modifications to build the new home based on the original specifications, they will permit it in a week, and they will allow you to build another 500 square foot dwelling on the land because there's a housing shortage in Napa.
That's if you're still the original owner, or even if
No,
you're
anybody.
a new owner?
You as the owner, if you owned it,
Like
you
if I
got-
went and I bought a 250?
if you bought the $250 lot,
I
you
could
got the
just go build in 1 week?
architect and the contractor, you filed the permit based on the original specifications and an additional dwelling unit on it, you could get permitted in a week. And then you pay $500 to all-in cost to reconstruct it, $750,000, you sell it for $1 million, you pocket $250,000. And the faster you do that, the faster. And then our company is actually, we're creating a modulated construction. So we're gonna get a 100,000 square foot warehouse in Sacramento. We're gonna build the walls overnight, then we're gonna grab the walls, and we're gonna take them up to Napa, and we're gonna assemble the house once the foundations are already in place. And then the inspectors are gonna come in and sign off on the plumbing and the electrical, and boom, we're gonna have the house built in, I don't know how many weeks it is to build it, and our goal is to have at least 10 to 20 homes in the pipeline per year.
But this is as investors or as
Yes.
construction companies?
We are the construction company and the architectural firm. So we can do the construction, the architecture, and the permitting.
And you guys are also the investors?
We've raised $5 million.
What
So there's the 20 homes right there at $250 a lot. So yeah, the investor.
And there's no regulations to stop?
They've relaxed the regulations, but almost all of the toxins have been remediated by the EPA. So they've already gone in and cleaned up all the lots. So we're not cleaning up the lots, the EPA cleaned up all the lots. Some people paid to get the lots cleaned up because they wanted to get started on the construction sooner. So you could do a whole paper around that, which would be totally relevant.
And of huge interest.
Hmm?
And of huge interest.
And of interest and of total value because you're bringing housing to an area that doesn't have any housing. Can you do it in Chico? No. Can you do it in Malibu? Yes.
Can you do it
Because
in
the
Redding?
economics are there.
Can you do it in places like Redding? Probably not as profitable.
Redding doesn't have the fires. It's Chico, it's
No,
Napa, and
There were some fire stores in North.
that's true. You got to look at the economics. The land values in Napa,
Oh.
in the primo submarkets, we can get the $1 million per sale on the house. In Paradise, we can't get the prices there. So the economics aren't there to be able to go in as a developer. So we're going to need, if we go into Chico, into Paradise, we're going to need subsidies. Probably federal, state, or local subsidies to basically give us some money to offset, the costs,
And
to
would that
lower the
still be
costs.
profitable, right, to a degree? Not, maybe you're not making $250,000 per house, but you're still getting subsidized by the government or the state.
If I'm not putting up the total 500,000, if I put up 250 and the government puts up the other 250 for the cost,
Yeah.
then that would lower the total cost, and I'd still get my $250,000
Right.
margin.
So both ways would
Could
be
either do it both,
profitable.
either way. But in Napa, I don't need government subsidies.
Yeah.
In
more
Chico, I'll need government
I
subsidies.
see. Okay.
In Malibu, I don't need government subsidies. They probably need government subsidies in Redding because the economics aren't there.
Okay.
Okay, so that's an awesome freaking strategy. Yours is a great strategy. Yours is great, yours is great, yours is great. What's your research strategy? you need to talk with these people to find out what they're doing. Okay, if you're not focused on something now, do you have an idea of what you're doing so I can help you formalize your business plan? Okay, it's got to be something that we can make some money off of. Okay, this is marketing analysis and housing policy class. Okay, it's real estate. We're in the business school. We should be doing stuff that's relevant. What's your strategy?
So I've been writing about housing policy.
Okay, drill it down into the economics and the market research and commercialize it as a business plan.
Yeah, unfortunately I've been doing like foreign policy
That's
as
fine.
of now. So I've been seeing that there's a lot of construction being incentivized, and they've been having reform in policy very recently.
What market?
This would be in the Swedish and Australian.
Okay, so you're basically putting together a investment program to invest in single-family homes in Europe. Okay, you got to walk us through how that works and why that would actually work, particularly with the currency conversion rates. I mean, now that the dollar has appreciated and what is it, the krone, and those are probably depreciating against the dollar, so it probably makes sense that we could actually invest dollars into housing programs in Europe. Are there any restrictions on us being able to do something like that? You need to figure that out.
Yeah.
So to see if you can maybe take what you're doing and then do the housing policy, do the housing economics, do the market research, figure out an investment program, commercialize it, convince us as though we were the investors, convince us to invest in your program. Okay.
I'm coming up with one right now. I'm thinking of living like around the area of the mall over there. Cause I live in Brentwood. I've seen some growth. I'm thinking of it right now.
Okay, well, lay it out so that you can get clarified, and then you need to call me so that we can walk through it and get you focused.
Can I send you like
Just
a
call me.
presentation? Like,
Call me.
Alright.
Don't send me stuff.
Alright.
Only send me something when you got your business plan totally laid out and you can communicate your economics. Then I'll look at your business plan. I'm not going to look at your business plan twice.
So if I do that, and then
You need to be able to convince me over the phone that I should invest in your program.
Alright. Okay.
Okay, and then I'll go. Then I'll look at it. Okay, or if you just put together an outline of what it's going to be, with some economics. So you're pitching an investment committee, you're pitching some investors to invest in your housing program. Okay, in Illinois, or Contra Costa County. The Brentwood's just a city in Contra Costa County in Northern California.
No,
So you got to be able to tell me,
I would do a bigger area, but that's what I'm trying to.
How are we gonna
more
make
of
okay, tell me how we got to make money. How are we going to make money?
I was going to do international markets in India, Southeast Asia, but
Do you have family that are citizens of India or Dubai where you can basically do that program from here, so you pull money here, I guess, and then invest in home development in India?
yes, I do have family there.
Are we doing upper class, middle class, or lower class?
Probably lower class.
Okay, is that possible?
That's what I have to look into. So I was thinking about trading it to America because I feel like that is easier to buy and with like affordable housing in big cities.
Yeah, I would actually go, the new wave right now is modulated housing, manufactured housing, new technology for housing construction on smaller lots and smaller footprints, to be able to create more density at lower costs. You'd probably do that in outlying areas to a certain degree, or do it in areas with high pockets. In rural areas with high property rates, you could probably do that there. Yeah, using technology to create low-cost housing, to high-quality, low-cost housing in locations with housing prices.
Yeah.
Okay, in subdivisions with services that can be basically provided to that economic and demographic group.
Is it worth try that one?
Okay, got it. Okay, anybody else? Any well, you guys work together and do it. Okay. All right, so let's do this. All right, so I'm still So what I'm going to do is I'm presenting the introduction to commercial real estate. This is the market research, this is market analysis, okay? So let's get into the analysis, okay? This is what's got to be going through your head when you're thinking about markets, okay? And it's, they got rid of the ladder, but they didn't get rid of the boxes. Okay, well, that's cool. So has everybody taken microeconomics class? Okay.
No.
So you have the units on the bottom, okay, which is your supply. This is the total inventory. This could be commercial real estate, or this could be single family. But I use apartments, okay, that I'm looking for when I'm doing this. So you have basically your supply curve and you have your demand curve. At the intersection of the supply and the demand curve is basically the price. But what we're using is we're using rent growth. Okay, it's rent growth. So when the market is in equilibrium, you're at the structural vacancy rate. The structural vacancy rate for apartments is 5% or 95% occupancy rate. At the 95% occupancy rate or 5% vacancy rate, the market is in equilibrium and you're getting the inflation rent growth, which inflation over the last 60 years has been roughly 3%. In the Bay Area, it's been 5%. Okay? So this is basically the traditional layout. In equilibrium, there's no incentive to build new product. So you're basically, the supply and demand is in equilibrium. Then the supply curve, you see how the supply curve is elastic here? See how it slopes up? But in real estate, that's not the true supply curve. The supply curve in real estate looks like that. It's perfectly inelastic. Because we can't instantaneously, if all of a sudden we get an employment demand shock and all these tech workers, start getting hired in the Bay Area, and we can't instantaneously build, 20, 50,000, units to basically meet that demand. And so the supply curve is completely inelastic. Real estate is a very unique asset class in that it has, in the short run, completely inelastic supply curve. Okay, so the employment demand shock hits. There's no new inventory that comes in the market. Rents spiked, and the rent growth goes from 3.5% in equilibrium to basically 8.5%. Rent spikes are considered rent growth rates between 8.5 and 22%. So if you go back in time and you look at the 1998, 1999, 2000, in 1997, 98, 99, rents were growing between 10 and 20% per year for apartments. And if you go back and you look at 2006, 2007, rents were growing at about 20% per year during the peak of the business cycle. If you go back and you look at the most recent 2014, 15, 16, rents were growing between 10 and 20% depending on the submarket. And because there's no new supply. And then as the demand curve shifts up, then your vacancy rates drop from 5% or drive from 5% down to 2 or 3% or even 1%. So basically it's frictional vacancy rates. So when vacancy rates reach 1 to 2%, you have frictional vacancy rates and you get rent spikes. Okay? The rents spike and the values of the property spike. Okay, at the same time.
Is that because there's more demand?
Because there's more demand. More demand pushes up the rents. More demand pushes up the rents, which pushes up the net operating income, that pushes up the value of the properties. At some point in time, the rents are going to get so high, and the net operating income is going to get so high, and divided by the cap rate, the values are going to get so high that they're going to become significantly higher than the cost of construction. At some point in time, when the value of the property is about 20% above the cost of construction or more, you're going to start to see developers move into the marketplace to start developing product, because if I can build it at 500, let's say $250,000 a unit, but I can sell it at $500,000 a unit, there's no arbitrage there. I'm going to build it until I wipe out the arbitrage. Okay? So that's basically what happens. So as the rents spike over time, let's say we're in a commodity market like Sacramento or Inland Empire or Phoenix or Tucson, where there's a ton of land, and the rent spike hits, and then all of a sudden they start to develop new construction, and the supply curve starts to move out. And the supply curve moves out as there's new construction. and then the market goes back into equilibrium. So you get the rent spike, and then the supply curve moves out to the new point of equilibrium, where the rent growth goes back to the long-term inflation rate. So the markets do respond in the long run, but the problem is that in supply-constrained markets, or this is an unconstrained market scenario. Sorry about that. So this is actually a scenario where the markets actually respond and reach long-term equilibrium. Here's the scenario in the commodity markets where actually they overshoot and they build too much. So actually they move past the equilibrium point, they build too much because there's too much land. If you go to Sacramento, Inland Empire, Phoenix, Tucson, Albuquerque, San Antonio, those city municipalities actually use construction as economic development policy for employment. So they promote construction. And since they promote the construction and they have so much land, the markets become oversupplied, and at some point in time rents start to drop, values start to drop because they oversupply the market, and at some point in time when the values drop below the cost of construction, they shut down the construction because there's no more arbitrage. And then here's the worst case scenario. You overshoot the supply curve and you go into a recession and you have a negative demand shock. So this happens in Phoenix and Albuquerque, and there's boom bust markets all the time. They have a ton of land, they promote construction, they overshoot on the supply side, and then the recession hits and the employment demand shock turns negative. So you get negative demand shock, positive supply shock, and rents are careening down and values are collapsing in the marketplace because of deficient demand and oversupply. That's the worst case scenario right there. And then what I don't have here that I should have here is a scenario here where you see the short-term and the long-term supply curve where it shifts out. In supply-constrained markets, the supply curve moves out and then stops like right in the middle between the two. Okay? So the supply curve does not move to its long-term equilibrium. It's actually supply constrained. And since it can't move out to the equilibrium point, rents and prices appreciate above the local inflation rate on a constant basis because the supply can never be met. Those are supply constrained markets. San Francisco is a perfect example. LA is a perfect example of that. Cambridge, Massachusetts is a good place for that. Midtown Manhattan is a good example of that. Those are supply constrained markets. Seattle's another supply constrained market. And so investment strategies, for example, for my company that I worked for, we were looking for supply constrained markets. Where are the supply constrained markets with high concentrations of tech workers, where they experience employment demand shocks constantly over time? Yes, it's more expensive to buy into those markets, but we felt that the rent growth and that the valuations would be elevated over the long run, and we would be able to create value for our clients, for our investors in these supply constrained markets. And then my recommendation is we need to get out of these unconstrained markets, particularly during boom bust cycles. So we sold off all of our properties in Phoenix, Tucson, Albuquerque, Sacramento, Inland Empire, San Antonio, Portland. We sold all of those markets and took all that money and deployed it in the Bay Area and in Southern California in apartment development in the supply constrained markets. So that was a research-driven strategy. This is basically the supply-demand using typical microeconomic analysis. Real estate also moves in cycles. Okay? This is basically the cycles right here. So you have basically phase 1, recovery, phase 2, expansion, phase 3, hypersupply, and phase 4, recession. That middle line right there that moves through the 4 quadrants, that's the occupancy and rent growth line. Okay?
The red one?
The black one. The black line. Do you see it?
The curve?
Yep, the black line. Okay, the black line that's going through phase 1, then goes through phase 2 with the red box, then goes through phase 3, and then phase 4. Those are occupancy, those are rent growth, that's the rent growth line. The 2 dots right there are the 2 equilibrium points. which basically mean at E1 and E2, you're at the structural vacancy and at the structural occupancy rate. Okay? So here's the scenario. We're in phase 1. There's no new construction. The economy is basically not in a recession, but there's no aggregate demand, and we're just waiting for the demand shock to hit. All of a sudden, the Fed uses accommodative monetary policy, drives interest rates to zero, stimulates the economy, and all of a sudden we start to get job growth. And as jobs start to be created, demand for space increases, net absorption increases, occupancy rate increases, rental growth rates increase. And then we start moving up that path. So we start to move up, the rents are starting to grow, occupancy rates are starting to rise. Then we reach the first equilibrium point. Once you go past the equilibrium point, you're now starting to get very low vacancy rates, and rents are starting to grow very rapidly because there's no supply that's coming into the market yet. And that red box right there is the rent spike box, okay? That's the point in which rents start to spike and start to grow between 10 and 20% per year. And there's no real new construction that's coming in at that point. Then as you start to move from phase 2 expansion into hypersupply, what you have is all of a sudden supply is starting to come into the marketplace. Rents are growing well above the inflation rate. Occupancy rates are at all-time high, and job growth is still probably at its peak in the business cycle. And then all of a sudden, new supply starts to come in, starts to push down the occupancy rates, but the occupancy rates are still well above the structural occupancy rate, which means that rents are growing well above the local inflation rate. As new supply comes in, this is probably 4 years into the cycle at this point. So over here, we're in year 1. By the time we get into phase 3, that's probably year 4 through year 7, depending on the market. Since occupancy rates are still high, or above the structural there, and rents are growing above the inflation rate, capital continues to flow into the real estate market, because everybody's doing their analysis and they're saying, hey, occupancy rates are still above the structural and rents are still growing above the inflation rate. So we're going to continue to deploy capital into real estate. But what they don't understand is that we've already reached the peak of the business cycle and job growth is starting to slow, and we're probably already starting to fall into a recession. So as new supply comes online and as demand starts to drop, we blow through the second equilibrium point. Supply continues to come online. Once we blow through that second equilibrium point, occupancy rates start to move up very quickly, rents start to fall, valuations start to fall, and the market is still in an oversupply condition, and we're in a recession. So quadrant 4 is oversupply, recession. Quadrant 1 is recession, no supply. Okay? I can plot along that line and in those quadrants each individual metro area by property sector. So test question. Where is the San Francisco office market right now? Is it in quadrant 1, 2, 3, or 4? It's probably in 3. Because there is new supply. There's been about 4 million square feet that have been built. There's another 4 million square feet that's probably on the books. So there is new supply. We've gone through already the rent spikes. We're already starting to see slowing job growth, slowing net absorption compared to 2014, 15, 16. So we're probably in quadrant 3. Where is the Bay Area in regards to single-family housing? What quadrant? Probably 3. So we're probably too early in the cycle to be, for most of the markets are in quadrant 4, because we're not in a recession yet. And we're so late in the cycle, there's already new supply, that we're not in quadrant 2. And we're definitely not in quadrant 1, where there's no supply or a recession.
Quick question.
Yeah.
So what's the time frame between phase 3 and phase 4?
It depends on the market and the property
In
sector.
the Bay Area.
So the office market and the apartment market, let's see, we started to recover from the Great Recession in 2010, 2011, and we probably saw rent spikes in office and apartments in 12, 13, 14. And then we moved into quadrant 3 in 15, 16, 17. And we'll probably be in quadrant 4 in 2021, 22, 23. So different markets and different property sectors, they move through the cycles at different rates. Okay? So as you learn about the different markets and the property sectors, you learn about the cycles. Okay? And you can be very scientific about doing the market analysis and cycle analysis, or there are other people that have been in the business for 30 years, they know this stuff, in their sleep. They know how long it takes. They know when the markets are recovering. They know when they see demand. They know when to start construction. They know when to stop construction. They know when to sell the properties. They know that because they've been through it 3 times. They've been in the business for 60 years because they're like 80 years old. So they've been doing it for 60 years. They're 80. They started when they were 20. Yeah, there's guys out there like that. Okay. So this is the cycle now. This is the microeconomic analysis. This is the cycle analysis. They basically do the same analysis, market analysis, but this is microeconomics using the graphs. This is cycle analysis using the cycles. Okay. What are some of the indicators of demand? Jobs. Jobs is the number 1 indicator, and this is on your exam too. Jobs is the number 1 economic indicator. So when I go into a market, the first thing I do is I look at the composition of the industries that employ the majority of the workers. So I do what is called an economic base analysis. So I look at the comparative advantage and the clustering of those industries and those firms within those geographic areas, and then I ask the question, are these industry sectors growing or contracting? Are they growing or contracting? When I go into an area. The second thing I do is if I'm doing some market research to figure out where we're going to invest, the first thing I do is what is the composition of the industries that employ the majority of the people within that geography. Or I say, I think that the high-tech, biotech areas continue to add jobs and be fairly resilient during the recession. So I want to look for markets that have high concentration of high-tech and biotech workers, and that's basically San Francisco and LA. If I'm doing a biotech play, I'm going to South San Francisco to be next to Genentech. If I'm doing a biotech play, I'm going to Berkeley and I'm going to be next to Chiron in Berkeley. If I'm doing high tech, I want to be in downtown San Francisco around the software industry. If I want to be a high-tech hardware exposure, I'm going down to San Diego and Mountain View to get the exposure there. If I want to do biotech, I'm going down to San Diego. We have high concentrations of biotech. Or I'm going up to Seattle that also has high concentration of biotech. If I want a military exposure, I'm going down to San Diego because they have high concentration of military bases. Up there, or I'm going up to Travis, or I'm going down to Monterey next to the military bases because they basically have lots of jobs. I also like to be investing in properties around universities and medical centers because they're resilient against the recession, and people who work for the universities and the medical centers are high-paying jobs. Okay, so those are the economic base strategies. I got alternative energy, clean energy, that's San Francisco, San Jose. Healthcare information systems, San Francisco, San Jose, and Sacramento. Financial services, San Francisco, San Mateo, Franklin Flats. Telecommunications and networking, chips, San Jose, Santa Clara County. Multimedia entertainment, Marin, Lucasfilms, San Francisco, Lucasfilms, San Francisco, gaming programming. Internet and software programming, San Francisco, San Jose, Oakland. International trade and tourism, SFO, Oakland Airport, San Jose Airport. Construction and engineering services, San Francisco, San Jose, Sacramento. Education and government services, obviously Oakland has some government concentration. San Francisco has state, local, and federal workers work in San Francisco. And Sacramento is the capital of the 7th largest economy in the world. Sacramento. And then defense. San Jose, that's basically Northrop Grumman, and you have the defense companies down there in San Jose. You have defense companies up in Sacramento. You have defense companies in San Diego. You have defense companies in El Segundo and in LA next to LAX. if I know where these industry sectors are going and which ones are gonna be the most resilient in the recession and which ones are growing jobs, that's where I'm going to invest in my commercial and residential properties as a strategy. So this is economic-based analysis. And then market and investment analysis. We've already gone up, I've already handed out to you the market research reports from CB. They will give you all the market research, they will give you the rent trends, they will give you the occupancy rates, they will give you the net absorption trends, they will give you new construction over time from the market research reports, overlaid, the market research reports with the economics and the demographics overlaid on top of it, basically will tell you where to invest based on the economic and the market fundamentals. And these are the market research reports. Okay? And you guys are all familiar with them. So you can do industrial, you can do office. You guys know where to go to get those reports. Commercial property portfolio construction. If I have a research strategy, Larry, we need a research strategy because our acquisitions people are just buying properties, wherever they can because they're incentivized basically to buy properties because that's where they get their bonuses. They're basically bringing us deals with no strategy behind it. Give us a research-driven strategy so that we can communicate that to our investors so that we can raise the money to deploy the capital within those areas that you recommend based off of your market research. So what are the strategies? Well, one could be risky, risk neutral, risk averse, or contrarian. These are the investor styles. Some investors just want return, they're risk neutral, we don't care about the risk, go into the worst markets, buy at pennies on the pound, do an opportunistic or a value add strategy, reposition the property and get the hell out as quick as possible. Okay, that could be one strategy. Or some investors say, okay, I want to wait until the recession's over. I want to wait until prices have collapsed. There's no liquidity in the market. There's no people in the market buying. I'm going to go in and I'm going to buy either right before the market bottoms or right at the bottom. So I'm going to be a contrarian investor.
Why would they buy before the bottom?
Because they're buying it at very low prices. And
Before the bottom.
right before the bottom.
It's still going to be on decline. So you
Yeah.
can buy a little bit shorter.
Yeah, so they're going to lose a little money, but they're going to make a shitload of money on the way up.
Yeah.
Okay? So they're willing to lose a little to get in because it's really hard to time the market. And I've seen investors do that in San Francisco. In the last downturn, some of the Hong Kong investors came in 2009 where there was nobody in the marketplace. There was a couple Hong Kong players that came in, bought some of these office buildings at $250 a square foot, and sold them for $750. And they bought right before the bottom. And then you have property sector styles. I want to build a portfolio just of office, or just industrial, or just retail, or just apartments, or just hotels. It's easier to do that than putting together a portfolio across multiple property sectors, because if I want to sell my portfolio and get out, if it's all industrial, I go find an industrial investor to sell the whole kit and caboodle to. It's easier for them to value the portfolio if they're all the same property sector. Okay? If they're multiple property sectors, and it's harder to sell. And I also have property type styles. I can either invest in Class A, Class B, Class C, or Class D properties. So Class A are, high rises, new construction, best tenants, best location. I want core properties, I want the best properties. That's my style, that's what I invest in. Some investors say, no, I don't want Class A properties, I want Class B properties, and then I want to go in to those properties, I want to rehab them, redevelop them, and bring them up to the A level. You can make a lot of money doing that. Bringing B properties to A level, or C properties to B level, or D properties up to the B level. That's called value add, okay, or opportunistic. You can have geographic styles. I want to invest all my properties within a certain trade area. I want to be just in Livermore and Blackrock, or Blackhawk. Maybe I want to be in a certain neighborhood. I want to be in Rockbridge, or I want to be in Montclair, or I want to be in a certain submarket, maybe Walnut Creek, or the 680 corridor, or the 580 corridor, or maybe I want to be in the Alameda, Contra Costa, Oakland, metropolitan area, or I want to be in the Northern California region, or I want to be in the US, or I want to be in Germany, whatever. So it could be country, region, metro, submarket, neighborhood, trade area. You're drilling down in. And once you get to the trade area level, now you get the next level down from trade area is property level. So what you're doing is you're underwriting these markets at different levels all the way down to the property level, and then underwriting the property to see if it's something that you want to actually buy. And then there's investment styles called core, opportunistic, and value add. Core is Class A, new quality assets. It's like buying a AAA rated corporate bond. It's never going to default. It's always going to retain its value. Opportunistic is I'm going to buy it. I'm going to put in some new systems. I'm going to do the I'm going to do some remodeling on it. I'm going to reposition the property. I'm going to move it up, and then I'm going to sell it. And then value add is this is a totally messed up property. It's in a good location. What I'm going to do is I'm basically almost going to tear most of it down. I'm going to redevelop it, reposition it. I'm going to put in all of my systems. I'm going to re-tenant it, and then I'm going to bring it up to a very high level. And either I'm going to keep it in my portfolio or I'm going to sell off to an institutional investor. I think I'll pass through this. Here's an example of some market research that I did. Even though it's a little out of date, it totally makes sense.
Are you going to share these slides?
Yeah. So what I did here was, this is for apartments. So I basically found a data set, and I calculated the average annual return over a 20-year period for the different metropolitan areas for the apartment market. So that left column right there is the annualized return, okay? And then I ran the standard deviation, divided the total return by the standard deviation to get the risk return ratio, the unit of return per unit of risk. And basically resorted and ranked the metro areas from the highest return to risk ratio to the lowest return to risk ratio. And basically came to the conclusion and told the board of directors that we should sell out of Riverside, Las Vegas, and Albuquerque, and we should sell out of Tucson, Phoenix, and Salt Lake City. And we should also sell out of Portland, Denver, and Sacramento. We should sell out all of those markets on the bottom, take all of the money from the sales, and deploy the capital in Orange County, San Francisco, Seattle, San Diego, and Los Angeles. Because not only did they give us high rates of return, well above the 12% hurdle rate, but they gave us the highest return to risk ratio over the investment time period.
Why did you exclude Sacramento and that's above the 12%?
Because Sacramento has commodity market type characteristics. We owned portfolios of apartment buildings up there, and we never really made any money up there. And the tenants that were fairly low quality up there.
So it was not really like a number thing, it was just based on the...
It wasn't the top 75th percentile markets. It was still below the 75th percentile markets. It was between the 50 and 75th. And it had commodity market type characteristics. So we said, let's sell off all those markets, take the money, deploy it into the top markets into development, redevelopment, and acquisition. And it was an extremely successful strategy. And it took me 1 year to do the portfolio research, and it took us 4 years to sell off all the properties that we deployed capital. So the total amount of time that it took to implement the strategy was 7 years.
So while you guys were selling, were you investing right away, or were you waiting to get all your capital and then reinvest?
We were restructuring the balance sheet at the same time. We were buying down the debt. We were increasing our line of credit so that we could issue bonds really quickly or issue stocks really quickly. We had a couple $2 billion line of credit with Bank of America and a couple banks. So we repositioned our balance sheet to become opportunistic. And then we sold off everything, restructured the balance sheet. Once we had the dry powder in place, we basically fired or moved all of the acquisition and development talent in the commodity markets and redeployed them into those other markets, or built new staff in those markets to then start finding deals for us to either develop or acquire. So this is a very simplistic equation that is extremely powerful from a market research standpoint in making recommendations at the portfolio level.
Approximately how much money would you say that it made the company?
Probably We were about $2 billion in assets under management, and probably by the time they deployed it 7 years later, it was about a $4 billion company. So basically doubled it in 10 years or less than 10 years, which is what you want. You want to be doubling your assets within 8 to 10 years. Okay, so you go 2 to 4 to 8 to 16. So the company right now is 16 billion. So it went from 2 to 4 to 8 to 16. So it doubled every 8 years. Yeah, it was pretty amazing. Okay. So market and asset selection. So diversification strategy, concentration strategy, and execution. So when I build these portfolios, I can either concentrate by different economic base. I want to be in all tech, supply constrained markets. Okay? Or I say I want to be diversified. I want to have some defense exposure, some university exposure, some tech exposure, and some medical exposure. And I'm not only going to diversify the assets across different industry sectors, but also geographic regions. So I'm getting industry diversification, and I'm getting geographic diversification. Or I can build a portfolio and say, no, it's all I want is high tech, high concentration, Northern California. I can do that now. And then the question is, once you come up with these strategies, you got to execute. You got to have a business plan, you got to have people, you got to have a process, you got to get this stuff done, and you got to get it done quick. You got to be able to close on these deals in less than 90 days. You underwrite it and take them out in 90 days. Okay. The development takes a lot longer. Property and portfolio management. When you're asset managing these properties, you're looking at the income statements, the actual numbers against the budgeted numbers, and you're looking at any variances that may occur. You're looking at the balance sheet. How are these properties leveraged? Are they conservatively leveraged or highly leveraged? Do you do construction, redevelopment, repositioning? The operating and project reporting. You got to look at ratio analysis. You got to have standardized intervals of reports. Weekly reports, quarterly reports, monthly reports, annual reports. You're constantly analyzing these things. And then you have to benchmark them against some performance metrics to see if you're reaching your hurdle rates. And you have to benchmark against internal and external performance benchmarks to see if it's working. And then you got to use variance attribution analysis, return on costs, controlling costs. This is all the asset management piece of the business. You're trying to control all of your expenses constantly. If I can maximize my rental revenue and I can minimize my expenses, I can maximize my net operating income, which is going to maximize the value of the property. So you're trying to minimize the operating expenses. And then you need to have leasing strategies. Okay, there's different types of leases for different types of properties. There's what is called sticks and bricks. So it's when you're leasing the space, it's just the walls and the roof. If you do clear shell leasing, it's the walls and the roof, inside walls finished with the electrical panel. You got a vanilla shell. These are your tenant's improvements. You're going to add in the ceiling, heating, ventilation, air conditioning, bathrooms, the electrical wiring, and base paint. And then the tenant's improvement are basically everything. So when you lease a space out, you got a tenant that's coming in, you're going to give them what is called a TI, or tenant improvement allowance. Depending on the tenant, it could range from $75 a square foot to $150 a square foot. The tenant puts in $75 a square foot, we put in $75 a square foot, they can build out the space with a budget of $150 a square foot and gooch the whole thing out, make it look beautiful. Okay. There are different types of leases. There's a gross lease, okay, where basically the tenant pays just the rent. There's a net lease where the tenant pays the rent and the taxes. The double net, the tenant pays the rent, the taxes, and the insurance. And then there's triple net leases where the tenant pays rent, taxes, insurance, and maintenance. Most retail leases are triple net leases. Okay? But there are triple net leases in office in really good markets, like in Rodeo Drive, or parts of Marin, where the market is so tight and the landlord has so much control They say, no, we're not paying for all that other stuff, you're paying for everything. You're paying for everything. And they can get away with it. When you lease out space, you gotta pay your leasing agent. You gotta incentivize them to go out and find tenants, to put the tenants in the space. And here's a typical rent. It's a 60-month rent for $5,000 a month. So it's a $300,000 rent. So
In 1 year?
no, this is over the lease, the 60 months. So the total lease is worth $300,000. So the broker will get 7% of the $300,000 in the first year, then 5,544. This is basically the way it's typically constructed. And then the commission rate is 25% divided by 5. 5% of the $300,000, the total commission is $15,000. And usually the listing broker will get 50%, and then the selling agent or the tenant rep will get the other half of the commission. And this is how they incentivize them and how they do it.
I need to study this.
Hmm?
I need to like slowly study this.
Hmm?
I'm gonna give you a copy of it.
Yep, I'll give it to you. And then you have time diversification within your properties. You don't want to concentrate all of your leases to expire at the same time. You want to ladder them over time. And if you know that the economy is going to go into a recession in 2021 and 2022, you should be writing 5-year leases or 7-year leases. So you're locking in the rents at a higher rate. You're skipping over the recession, and the lease expires once you get past the recession and you're back into the recovery. So you can use the leases to diversify and to mitigate some of the damage associated with the recession if the tenant doesn't default on the lease and go bankrupt. Is that what you're going to say? Yeah.
Would it be worth leasing below market price in order to capture the lease for that amount of time?
Usually what we would do is we would sign a lease at the market rent, where we would give the tenant maybe 2 or 3 or 5 months of free rent to give them a concession, to lower the effective price, to incentivize them to rent. But it goes mark to market. It goes back to the lease contract rate at some point in time after the concessions burn off. That would be our strategy. We wouldn't lower the rent, we would just give them free rent or some other concession to get them in. Okay? All right. So we want to target tenants that have really good credit, okay, in most cases. I saw in the .com, .bomb era, a lot of these landlords basically were going after high-tech tenants. They were waiving rents for stock options in the tech company. And then when they all blew up, one of the buildings in downtown San Francisco became 50% occupied. They defaulted on the mortgage. It went back to the bank sold the building at a fire sale to an opportunistic investor. And so it was a totally stupid strategy. The landlord was greedy. And so you can diversify your building by different types of tenants and different industries by different credit. Okay? So that becomes a strategy too. Investment analysis, again, acquisition and operating data. We're looking at cost, financing, income, expenses. We're putting in assumptions on rent and expense growth rates. We're looking at cash flows. We're looking at different sales scenarios, and we're calculating rates of return, and we're calculating the present values. So here's an example of the net operating income for these buildings. So you got the gross potential income, which is the rent times the square foot, minus the vacancy rate and the collection losses. And you add in any other income, parking or laundry. You get the effective gross income. You take out the operating expenses, and you get the net operating income. There are different ways to value these buildings. One is the sales comparable approach. I got 3 buildings that sold within the last 12 months. I know their price and I know their square foot. I can calculate the price per square foot for the 3 properties. I can get a range of values. I know the square footage of my building. It was very similar to the other 3 buildings. I take the square footage, price per square foot of the 3 buildings that just sold, multiply it by the square footage of my building. I get the estimated value of my building, use the sales comparable approach. The cost approach, I figure out how much it's going to cost to rebuild my building. I got a 250,000 square foot building. I know it's gonna cost $600 a square foot to replace the building. It's 250,000 square feet times $600 a square foot. That's the cost basis of the building. That's how much it's gonna cost you to replace the building. That's the cost approach. And then the income approach, there's two approaches. There's the discounted cash flow approach, and there's the income capitalization approach, or income cap. If I know the net operating income of my building, and I divide the net operating income by the cap rate, or the required rate of return, I'm gonna get the value of the building. If I go into the marketplace and I find 3 buildings that recently sold, and I know the cap rates at which they traded at, I can apply those cap rates to my net operating income to get the value of the property. Okay? So there's some other ways of doing it. Sales price to schedule income, gross multipliers, I can do that. The cap rate approach, net operating income divided by the sales price, net operating income divided by the cap rate gives me the sales price. If I know the net operating income of the property and I subtract out the mortgage payment, I get the net cash for the cash of the equity holder divided by the down payment of the equity that I paid. It's going to be my cash from my return on equity for the property. This is all investment underwriting. Oops. And this is the cap rate calculator. So if I take the net operating income and divide it by the cap rate, I get the sales price. If I take the net operating income and divide it by the sales price, I get the cap rate. And if I take the cap rate and multiply it by the sales price, I get the net operating income. So I can basically, if I have any one of the two, I can determine the other. So I have 2 knowns and 1 unknown, I can figure out what the other one is. So here's just an example. I got a $100,000 net operating income. I got a cap rate of 8%. The building's worth $800,000. Pretty simple. Present value approach. Basically, here's my schedule. I got the initial investment. I got the payments. And then I can calculate using the calculator or the software program. I can calculate the net present value, or I can calculate the internal rate of return. Okay. I usually use Excel. Here's another example of the net operating income. Here's basically the pro forma, where I project out the potential gross income, the vacancy factors, the effective gross income, the operating expenses, and I get the net operating income over the 5-year holding period. In the 5th year, I got the expected sales price minus my commissions. I get the net sales proceeds. And I'm going to add that to the 5th year net operating income. Then I'm going to discount that back to the present using a 12% discount rate. My present value on the property is $891,846. If the property is selling for $800,000 and I think the value is $892,000, I'm going to buy the property because I'm valuing it at $892 and they're selling it at $800. My value is higher than the current price. I'm going to buy the property, and I'm going to get a higher than a 12% rate of return. So that's the discounted cash flow approach. If I know the present value and I know what it costs, if I take the present value and I subtract out the acquisition price, I'm going to get the net present value. If the net present value is positive, we're going to do it. If the net present value is 0, we're going to do it. If the net present value is negative, we're going to reject it. We're not going to do it. So these are the investment decisions. Net present value positive, buy it. Net present value 0, I'm still going to buy it. Net present value negative, I'm not going to buy it. Net present value 0, I'm going to buy it. Okay. Those are the decision rules. And then my internal rate of return. When the net present value is negative, my internal rate of return equals my expected return. When the net present value is positive, my internal rate of return is higher than my expected return, or my required return. When the net present value is negative, then my internal rate of return is less than my required rate of return. So these are just the decision rules that we use in making investment decisions. And then we have mortgage financing. So there's financing available for all kinds of properties through different types of loan programs depending on what they are. There's different interest rate, mortgage interest rates, prime rate, 12-month treasury, or the 11th district funds rate. When you qualify for a loan, they're going to look at the client's history, its credit, we're gonna look at the business model, we're gonna look at the building as the collateral, and what the quality of that is. I'm gonna look at the gross income minus the operating expenses. I'm looking at all of these expenses for maintenance and everything, and I'm doing the qualifications. I'm gonna take the total operating expenses divided by 12. I'm gonna divide the net operating income by 1.25, which is the debt coverage ratio. I'm gonna take the monthly payment interest rate, the term of the loan, and to determine how much of the loan I will qualify for. I take the sales price minus the loan amount is gonna determine how much of a down payment that I'm gonna have. So when you're working, when you're gonna buy a home or buy a piece of property, you're working with a mortgage broker or a mortgage banker, and they're gonna basically work with you to figure out how much loan you can get to buy this property based off of your history, your credit, collateral, and all of this. Okay. And then you're gonna get your loan application, and the description of the property, I need all the legal aspects associated with the property, I need environmental reports, I need cash flow, pro forma estimates, I need all of the budgets, I need an appraisal report, and I need all the market research and the feasibility study. I need everything. Give me the 7 boxes of everything for the property so I
What's
can.
the appraisal report? What's the appraisal report
Yeah, the appraisal report. It's a valuation.
of the house?
So or the building. So you hire an appraiser, and they will give you a valuation. Or the bank will do it internally, but usually you use an MAI appraiser or an independent appraiser. So when you're underwriting the property and the borrower, you're looking at property type, quality, location, tenant quality, the lease terms, environmental, and then the borrower's experience and their resources, whatever else they have.
What's an underwriter?
Huh?
What's an underwriter?
The underwriter is the person who's underwriting the property, the borrower, and they determine, should I fund the loan or should I not fund the loan? They're the person who decides if the bank's gonna lend or not gonna lend. So they're looking at max debt service, so it's the net operating income divided by the debt coverage ratio, loan to value, what is the loan divided by the value of the property? Before you used to be able to put up 30% of the property value and did 70% loan, but after the financial crisis, the banks became more, their underwriting standards became more stringent, and you had to put up more down payment to get the loan.
No, they just told me less.
Huh?
You just told me less. I was trying to.
Well, yeah, now it's less, but I'm just saying after the financial crisis, you had to have really good credit, and they weren't gonna do a 70-30 loan to value. So they've loosened up their lending requirements since then, but it used to be really
You
strict.
also have to pay, if you're doing less than that, you also have to pay the mortgage insurance.
Yeah, or there may be other fees,
Yeah,
or,
there's other fees associated.
yeah, there may be covenants or fees or something like that if you start to over leverage the property. The bank's gonna want to be covered for some of that stuff. Debt coverage ratio, the net operating income divided by the debt service. How much cash do you have on hand to be able to cover the debt? And there's ratios around all the stuff that the banks use to be able to decide if they're gonna do it or they're not gonna do the loan. And then the leverage, if you're using borrowed money to buy these buildings, and these buildings perform, leverage basically increases the return on equity in an exponential rate. But if all of a sudden the rents are falling, the values are falling, then the leverage actually moves in the opposite direction. So leverage will leverage your return on equity if the building is performing. If it's not performing, then the leverage has a negative effect, and it moves in an exponential fashion. So leverage is a two-edged sword. And then here's an example. Here's your net operating income with different loan to values. There's your debt service. There's your before tax cash flow. There's your initial equity. There's the before tax cash flow divided by the initial equity. So you see as you lever up the property, your before tax flow divided by the initial equity or your return on equity starts to move up. And your internal rate of return moves up significantly. That's why investors use borrowed money, because they can leverage up the return. Taxes and exchanges, I'm going to end it after this. Taxes and exchange, once you buy these properties and you hold these properties for long periods of time, as you own these properties, you're taking depreciation, okay? The IRS says that you can take the cost basis of the property and divide it by 29 years or 30 years, and whatever that annual depreciation is, that's the amount that you can lower your taxable income. So depreciation lowers your taxable income. And
Even
puts-
if you refinance, you go back to zero or no?
when you refinance the property, you're refinancing the equity in the property. Okay, but this is amortization, this is depreciation. Okay, this is the depreciation allowance that the IRS gives you when you buy the property. This is depreciation. Okay, that lowers the taxable income from the property. Doesn't have anything to do with the
No, well,
lending.
my thought is, so I buy a house for 30 years,
This is commercial.
5 years or
This is commercial. You can't depreciate homes.
got it.
Okay, this is commercial. Okay, so let's look at the, this is the taxable income. So we got net operating income minus depreciation, minus interest expense, minus amortization, there's your taxable income. So the interest expense, the depreciation, amortization lowers your taxable income. Apply the tax rate, there's your tax liability. That's why people love real estate, because you have all of these deductions. That lowers your taxable income. You get your NOI, you take out the expenses, the amortization, you get your before tax cash flow, you get your tax liability, you get your after tax cash flow. Okay? And then you take out the mortgage, then you're going to get your cash on cash. Okay? The depreciable basis is basically the cost of the building divided by the years of depreciation. Okay, so over the years, this is the allocation. Apartments can be depreciated at 27 and a half years. All commercial is 39 years. So this is the key right here. So I bought the property at $600,000. It went to $1 million. The difference between the $600,000 and the million is my capital gains. And capital gains right now is as high as 20%. So the difference between my cost basis and the appreciated value, I'm paying capital gains. And since I'm taking depreciation, I'm lowering my cost basis. So that when I decide to sell the property at the end of the 27 and a half years, the whole thing is going to be taxable. Because I've zeroed out my basis from depreciation and I have to pay capital gains. So I could pay 45% right there on taxes, plus 10% transfer taxes. That's 55%. Plus Obama, care. That's like another 10%. So that's 65%. And then maybe other taxes in there too. So I'm looking at a 65% tax on my net proceeds.
Why
I'm not
Obama?
going to do it.
Why Obama?
Because Obama tax. It's the healthcare law added another, I think, 5 or 8% tax on everything. So you have to add that in if you sell real estate. You got to pay the Obama tax, healthcare costs. Okay? So you can't sell the property. So what do? You can't keep it. You can't sell it. You've already used all your depreciation. You can't keep it. You can't sell it. So you got to do the 1031 exchange. Okay?
What's that?
Basically what you're going to do is you're going to roll the property over into another property of like kind at a higher basis. You're going to put up more down payment. You're going to take all that equity. You're going to roll it into another
So
property.
use the property as collateral?
You're going to use all of the gain that you had, everything from the prior property is going to be rolled into the new property. And you're going to put up more down payment. And the down payment that you put in, you'll be able to use to depreciate again over the next 29 and a half years. So what you're doing is you're basically deferring your gain. And just as long as you can continue to 1031 exchange, you don't pay any taxes. And here's the kicker. If you roll the property over into an irrevocable trust and you die, the property goes to your heirs on a stepped-up basis and they pay their taxes. And if you have life insurance, when you die, the beneficiaries will get the life insurance death benefit, and they will use that death benefit to pay off the mortgage on the property. So the property is going to be heirs on a stepped-up basis, no taxes, and no debt. Okay, that's the key. I'm going to end it there because I think I'm done. Okay, so that was basically a crash course